We're going to be talking about capital gains in the Social Security Tax Torpedo. So what I believe is one of the biggest tax hurdles that we need to be thinking about as retirees. It's a tax hurdle that applies very widely to most retirees. Almost all retirees have Social Security. And so this is a tax trap that is going to be right top of mind throughout your retirement. And we're going to be talking about how you can use your taxable account inside of the Social Security Tax Torpedo to save thousands. Obviously, taxable accounts have a different, or I should say long-term capital gains have a different tax consequence coming from your taxable account versus IRA withdrawals. And so we've commonly looked at the Social Security Tax Torpedo from an IRA withdrawal standpoint. And now we're going to be looking at it through a little bit different of a lens. And towards the end of this video, you'll start to see how the complexities arise and how every decision in retirement, specifically from a tax planning perspective, is a layered decision. And so we'll talk through what some of those layers are to make sure that you're not just making a surface level decision, but rather a that bottom layer, that core layer that actually delivers growth and tax efficiency to your situation. So we know that we have different from when we're working. When we enter retirement, we have different tax buckets. We essentially have a taxable account bucket that would be a joint account, a brokerage account, TOD account, non-qualified account. There's a lot of different names for it, community property accounts. We also have our IRA accounts, our tax deferred accounts, whether that's 401k IRAs, and then we obviously have that Roth account too. That is generally tax-free, so we don't really look at it too much in considerations in terms of pulling from those given assets and seeing what that does in the Social Security Tax Torpedo, because at the end of the day, there isn't a tax consequence for Roth withdrawals. So it's really these two tax buckets, your tax deferred accounts, as well as your taxable accounts that have these different dynamics inside of the Social Security Tax Torpedo. And understanding these dynamics is extremely important. So on the screen right now, I have for married filing jointly. And again, obviously single filers have a slightly different kind of tax obligation. Essentially, you have each of these brackets for the most part are cut in half for a single filer. There's some other adjustments as well, but just for simplicity's sakes, we're gonna move forward with married filing jointly. As you're pulling from your taxable account, okay? If you've held investments for more than a year, meaning that you bought an investment, held it for more than a year, and now are selling out of that investment, it's long-term capital gains. You have a preferred rate. You'll see that on the right side of the screen here, the given preferred rates, and I got to grab my drawing tool here. These preferred rates on the right side of the screen. Short-term capital gains would be holding less than a year, and they would be back on the ordinary income side of things. Tax-deferred withdrawals are all on the ordinary income rates. When you have Social Security, that starts to become taxable. That's ordinary income rates once again. Pension, annuity income, generally, again, depending on what type of annuity account it is, if it's a qualified annuity, those are all going to be ordinary income withdrawals. And what you can see right off the bat, again, we've covered this in numerous videos, when we're looking at our income level at any given point in time, okay, there is going to be a benefit from taking from long-term capital gains versus taking from married filing or taking from ordinary income rates. Okay, and this also, again, transitions inside of the Social Security Tax Torpedo. So again, just to kind of cover some basics as we're starting to think through things. When we're talking about, throughout this presentation, generating long-term capital gains, the amount of income that individual would have taken in that situation might vary widely. That's because when you take from a taxable account, well, I should say, to back up for a second, when you put money in a taxable account, essentially what you did is you paid taxes on the income that you made. And so there's tax dollars that were already taken out, and then you place that money in a taxable account. This is what's considered cost basis. So then when you invest that cost basis, you're going to have growth. And as part of that growth, there's going to be unrealized growth, meaning that you have your cost basis that when you withdraw it would be tax-free. And then you have that unrealized growth that, depending on when you sell it, if it's a long-term capital gain, that's where that long-term capital gains would generate from. And so cost basis versus unrealized growth in every taxable account is going to be wildly varied, okay? And so when we're talking about the taxable portion and what translates into really any kind of tax graph, we're talking about only the long-term capital gains. If somebody, let's say we have two scenarios here. If somebody would take $70,000 from this first scenario, they have a cost basis of $50,000, and they have long-term capital gains that they're realizing, that's going to be $20,000. So they're actually taking $70,000 worth of income, but they're only having a taxable portion that's $20,000. Now, this might vary widely in somebody else's situation that has been investing that account for maybe a little bit longer, or maybe just has some more substantial growth because of the different investments that they're investing in. And so maybe they have half a cost basis and half unrealized gain. Again, when this person's realizing this $35,000 of unrealized gain, or they have, I should say, their cost basis is $35,000. So when they take $70,000 of taxable income, $35,000 is tax free, $35,000 is long-term capital gains. And so again, the long-term capital gains that you're realizing when you're realizing income out of that taxable account will only be a fraction of the total amount that you take out, because a portion of that is going to be cost based. Now that's going to, again, could vary widely. There could theoretically be a situation where somebody decades ago invested $5,000 and it grew to $70,000, and so they have $65,000 of long-term capital gains. So that will vary widely based on your situation. So make sure you're translating that in your mind as well. If you have high cost basis relative to the unrealized gain that you have, obviously realizing income from that taxable account, you'll have a lot more that's tax free versus having that long-term capital gain there. But as you've seen a lot of times when we're talking through the Social Security Tax Torpedo, we're essentially looking at increasing IRA withdrawals and how that affects and what that translates to for your marginal bracket. At most, we've ever been looking at, let's say, a base dollar amount of long-term capital gain. So for instance, let's say your taxable account generates $3,000 in a tax nuisance because of mutual fund capital gain distributions or dividends or whatever it might be. And then we look at that as a static amount and look at increasing IRA withdrawals through the Social Security Tax Torpedo. So again, what that's looked like and what that commonly you've seen from this Social Security Tax Torpedo type of graph is when we have this x-axis down here, we're using income from, it's labeled as income from taxable sources. More transparently or more accurately, it should be labeled income from ordinary income sources. Okay. But we've always looked at, okay, as you increase IRA withdrawals or pension income or annuity income or whatever it might be, RMDs, looking at how it transformed the Social Security Tax Torpedo this way. Okay, and not really looking at what it looks like to increase long-term capital gains and how that transforms the Social Security Tax Torpedo. Okay, and so we're going to kind of reverse this. Obviously, again, within this presentation, we're focusing on long-term capital gains. So we're going to kind of reverse this. At most, we're going to be looking at a base IRA withdrawal. So let's say that you have $10,000 in a pension or $20,000 in an RMD, and then we're looking at taking from long-term capital gains. And what you'll notice is these brackets are completely transformed. And again, this makes sense because, again, we're looking at the double taxation effect of IRA income being taxed and then that forcing some Social Security benefit into being taxed. Now we're going to be looking at essentially long-term capital gains being taxed, and then once again, forcing Social Security to be taxed. And so when we look at the Social Security taxation calculation, okay, your Social Security your Social Security benefit, how much is actually taxed, is based off a formula called provisional income. I have the formula on the screen right here. And what adds together to deliver your provisional income is gross income, tax-exempt income, money from muni bond interest, and then 50% of your Social Security benefit. Well, this gross income right here, it really doesn't matter what type of gross income you have. There are a lot of things that would be included in here. Pension income would be included in here. IRA withdrawals, obviously RMDs are just an IRA withdrawal. But even long-term capital gains force more of your Social Security benefit into being taxed. So whether it's a long-term capital gain, whether it's an IRA withdrawal, they're counted dollar for dollar against you in terms of forming Social Security's taxation. So once you find your provisional income, you basically plug it into this given table right here. And obviously, the more that you have in gross income, the more that you have in Social Security benefit, the higher your provisional income is going to be. The higher your provisional income, the more of your Social Security benefit is going to be taxed. Okay. Now, again, for those that haven't seen a ton of our trainings on the Social Security Tax Torpedo and this double taxation effect, know that this happens slowly. So when you're in this 50% zone, for every dollar you add of provisional income, you force 50 cents of your Social Security benefit into being taxed. Okay, when you're in this zone, for every dollar you add of provisional income, it forces 85 cents of your Social Security benefit into being taxed. So essentially what's happening that's creating this double taxation zone is you raise your gross income, whether it's long-term capital gains or IRAs, by $1. It raises your provisional income by $1, but it also forces more of your Social Security benefit into being taxed, 50 cents or 85 cents. And so taking $1 of income causes $1.50, $1.85 into being taxed. Thus, you see this raise in this marginal bracket. And so, again, this rising in the marginal brackets due to this tax trap will look slightly different. Okay, because again, what's going to happen is Social Security is taxed based on ordinary income rates. But you have these long-term capital gains that are being taxed differently. And so essentially, again, what's going to be happening is, let's say you take long-term capital gains in the 0% zone right here. Now, everybody would think, hey, this means that I'm in a 0% tax bracket. I should take long-term capital gains. But again, we also have to translate this to what's happening on the Social Security side of things. If we're raising our provisional income and we happen to be in a zone outside of the standard deduction, that dollar of long-term capital gains might be moving 85 cents of our Social Security benefit into being taxed. Well, if we're taxed at 10%, 12%, obviously at 22%, we'd be moving into that 15% bracket. But if we were taxed at 10 or 12%, we've essentially moved 85 cents of our Social Security benefit into being taxed at 10 or 12%. And so there is an elimination here of this 0% long-term capital gain bracket, at least outside of the standard deduction. So we're going to talk through in a second how there's a stretch of the standard deduction, or the benefit you get from the standard deduction here in a second. But let's assume we're outside of the standard deduction. The 0% long-term capital gain bracket doesn't exist anymore. Reason being is because, again, this double taxation effect. And so here's what's generally happening, or what people intuitively think is happening, that they're in the 12% ordinary income bracket, let's say, and they're in the 0% long-term capital gain bracket. Again, we can see that, if we're less than $83,550 of our total taxable income in both of these scenarios, we're in the 0% and we'd be in the 12%. Okay. So they think, okay, if I take $1,000 of long-term capital gains, that's tax-free. I'm in the 0% bracket. And that's true. The capital gains is in that 0% bracket, but it's, again, about what else moves into being taxed as ordinary income. And as I just kind of discussed, if we're in the 12% bracket, this $1,000 of raising our provisional income, even though we're in the 0% bracket, it's still raising our provisional income, is forcing $850 of our Social Security benefit now into being taxed. And that's taxed at 12%. And so there's an elimination of this 0% long-term capital gain bracket outside of the standard deduction, because we're essentially at if we're in the 12% bracket, we're at a 10.2% bracket. For every $1,000 that we take of capital gains, we're owing 10.2% as a tax rate because of the Social Security benefit that moves into being taxable. If we were in the 10% bracket and we had 850 move, we'd obviously be in a marginal bracket of 8.5%. Now, those are both extremely low rates. I'm not saying that that doesn't make sense to realize that income in those given zones. We just need to understand that we're not in that 0% long-term capital gain bracket, or we are from a capital gain standpoint, but we're moving more of our Social Security benefit into being taxed. And so, again, this is something we've talked a lot about, but it deserves reiteration, if you will, on how your income stacks in the eyes of the IRS. So when we think about stacking, luckily the IRS stacks in the most optimal way you could stack. And you start out with your normally taxed withdrawals. And so you have what I would generally say is guaranteed income, where we don't have a choice to take that money. Social Security would be at the bottom of that, pension income, annuity income, those type of things. But then we have another kind of zone within that first zone there, where if we're taking an RMD, we're taking IRA withdrawals. Again, that stacks on next. Capital gains stacks on top of that. So it stacks on last. Again, this is preferred because we have lower rates for long-term capital gains when we're taxed at those given rates, but nonetheless, it stacks on next. And then we have Roth withdrawals that stack on last. And again, don't really even stack because they're tax-free. And so here's what this looks like on the right-hand side of the screen. We're looking at 2022 brackets for a married couple, and they have $60,000 of Social Security income. They're above 65, so they're going to get an increased standard deduction for being above 65. And we're looking now at the x-axis being long-term capital gains here. And what you'll notice is this looks completely different from when we're looking at IRA withdrawals. Obviously, this is completely different looking Social Security Tax Torpedo graph. Now, again, we're looking at $0 in IRA withdrawals. So for whatever reason that might happen, maybe they're not taken from their IRAs. Maybe they haven't yet reached the age of RMDs. Maybe they converted enough where they don't have any other IRA withdrawals. Okay, there can be numerous reasons for this. But as we can see, if this person is just taking from long-term capital gains, there is this 0% zone. The 0% zone, again, I know I said there was an elimination of this 0% zone, but the reason this 0% zone still exists, and I'll show very visually how this still exists, is there's a stretching of the standard deduction. Essentially, with long-term capital gains, you're going to get more distance out of that standard deduction. Again, I'll show why in a little bit here. But then we see that, again, in this 0% zone, when we finally get to a point where Social Security is taxed at this 10% zone, we see 8.5% is our marginal rate. And then we still see a very swift and fast spike here. Luckily, it's a short spike, but of 37.95%. I'll cover how we get to this 37.95%. But again, the big message that we'll notice here, if you've watched some of our trainings on the Social Security Tax Torpedo, and if you haven't, I'll link to that in the upper right-hand corner if you're watching this on YouTube. Otherwise, let me know in the comments below if you're on our Safeguard or if you're on our Retirement Mastery Facebook group, and I'll kind of link to some of those if you're not fully familiar with the Social Security Tax Torpedo. But we see there still is a very aggressive zone. And again, we don't need to understand how this is created yet because I have additional slides that will show this. But then we see, again, long-term capital gains eventually switches into this 15% bracket. Okay, so what do I mean by the stretching of the standard deduction? And again, keep in mind how your income stacks in the eyes of the IRS. Essentially, what's going to happen is as we raise our gross income from any source, specifically we're looking at long-term capital gains, we are forcing more of our Social Security benefit into being taxed. Now, the thing is here with our Social Security benefit being taxed is it might still be taxable up to a certain extent, but remember, we have that standard deduction. Whereas if we have Social Security taxability within that standard deduction, it's as if we're not taxed at all on our Social Security benefit, because again, we're taxed at that 0% rate. We get that essentially room, that deduction that's forgiven for us. And so we're going to look at 3 different capital gain zones and essentially see how our taxability can transform based on these given zones and how we get a stretching of the standard deduction. So again, we have $60,000 of Social Security coming in. If our capital gains were $20,000, okay, we would have in that provisional income, we would have $20,000 of gross income, and then we would have $30,000 because half of our Social Security benefit, and that would combine and basically translate to $11,100 of Social Security taxability. Now, again, there's $11,100 of Social Security that would move into being part of our taxable income, or part of our AGI, I should say, but then it's underneath the standard deduction. And when our long-term capital gains stacks on next, $20,000, we're still well within the 0% zone. So you'll see here that at $20,000 of long-term capital gains, we're in a 0% zone. Again, this makes sense. We're underneath the standard deduction for our ordinary income rates, and we have long-term capital gains that are still well within the 0% bracket. Now, for every subsequent $20,000 we add of capital gains, we'll see this transform. Okay, and why I say this is because, again, now we have $40,000 of long-term capital gains, so our tax base is going to rise. It's going to rise partially because of that $20,000 of long-term capital gains, that extra $20,000, but it's forcing more of our Social Security benefit now into being taxed. Now, again, we get we're a married couple. This situation is, I should say, above 65, so they're getting an add-on to the standard deduction. So that's why this $28,100 is still within that standard deduction, still within the 0% zone. And again, we get a stretching of the standard deduction here. The reason being is because, yes, our long-term capital gains are moving more of our Social Security benefit into being taxed, but remember that Social Security benefit stacks on first. So it's that first money, if we don't have any other IRA withdrawals, that we can take a lot of long-term capital gains in terms of long-term capital gains and still be underneath that standard deduction. So there's a stretching of the standard deduction that can happen. We can essentially take a lot more income within that zone here because, again, we're in the 0% zone for long-term capital gains, and the Social Security taxability is still underneath the standard deduction. Now, again, note that as we talk through this, this $40,000 of long-term capital gains, they might be taking $80,000 of income there. Because again, that long-term capital gain is only a fraction of that taxable account. Finally, at $60,000 of capital gains, we now see where this double taxation zone happens, essentially how we reach this 8.5% zone here. And again, we'd be over here with $60,000. Essentially what's happening here is now we're finally past the standard deduction. So as soon as we're past the standard deduction, any additional long-term capital gains raise our provisional income, raise our Social Security taxability, and now we're seeing this tax effect here where we're being taxed at 10%. Now, again, for every dollar we add of long-term capital gains, we're only moving 85 cents into being taxed. And so we have, again, that marginal rate is only 85% of this zone, 10%, so 8.5%. Okay, but essentially, again, the 0% bracket, once we're past the standard deduction, is essentially eliminated because we have this 8.5% zone, but we're getting a stretching of the standard deduction, if that's the way you kind of want to think about it, okay? Now, this being said, how do we get to this 37.95%? Again, this is all based on $0 in IRA withdrawals, so stick with me as we start to raise that. You'll see this completely transform and the complexities start to arise, but just stick with me throughout the rest of the presentation to kind of see how this starts to build together, trying to build in a logical way to increase understanding around this. So let's first cover how this 37.95% situation happens, okay? And how it happens, and again, basically before this $1,000 extra capital gain withdrawal, we're basically right on the edge of, we're basically showing this right on the edge right here is where our income is falling. So we're going to take an extra $1,000 and essentially see how this translates to this 37.95% zone, okay? But before this $1,000 withdrawal, notice that we're at Social Security taxability, bumping right into this 12% zone here. And then we have long-term capital gains that are relatively substantial here, that are right below this 15% capital gains zone. And so again, we're still in these zones where it's, we're paying 8.5% was our latest marginal rate. But now what's going to happen is, for whatever reason, we're going to take an extra $1,000 of long-term capital gains. Maybe we had an extra $1,000 mutual fund distribution at the end of the year, okay? So intuitively, what you think would happen is we're essentially just adding $1,000 of long-term capital gains here that's being taxed at 15%, and you think that's all that's happening. And that's missing a huge part of what's actually happening. So yes, you will owe that $150, 15% on that extra $1,000 withdrawal, but what else is going to happen? We're raising our provisional income by $1,000. Again, we're not yet to full Social Security taxability. $60,000 is how much we're taking from Social Security. Full taxability would be 85% of that. And so we add $1,000 here. What's going to happen is it's going to move an extra $850 of our Social Security benefit into now being taxed because it raised provisional income. And so we have 85% of whatever we rose our provisional income by is now Social Security taxable. And so that's going to be here at this 12% bracket because, again, we now just moved into this 12% bracket here. So we owe at least an extra $102, okay? But again, what happens then when we add an extra $850 of tax base? It's going to push $850 of our long-term capital gains now into an additional tax up here. And so we're seeing this capital gain bump zone, if you will, of our tax base pushing more of our Social Security or more of our long-term capital gains being taxed at 15%. And so we see another zone here where we have another $127.50 because we have $850 of not additional capital gains, but additional capital gains taxed at 15% because we have this tax base here that grows by $850. So we see how this 37.95% bracket is created, $379.50 off a $1,000 capital gain, okay? So let's start to expand this now. Okay, we know that there are still some pretty large jumps here. Regardless of if we're looking at long-term capital gains, we still see some pretty high marginal rates, higher than the highest normal marginal rate would be at 37%. But again, it doesn't happen for a very long time. Again, somebody that had all of their raw or tax deferred dollars eliminated and they were only taken from taxable accounts or Roth accounts, they'd be able to take almost, quite a large amount of long-term capital gains because, again, long-term capital gains are only fractional, that they would be in this 0% zone or at the very worst, in some fantastic marginal brackets, any way you slice it. But what happens when we start to add IRA withdrawals? What you're going to notice is, as we go through some of these charts, adding IRA withdrawals essentially removes, for every dollar of IRA withdrawals, it removes $2 worth of that 0% standard deduction zone. Okay. So again, we already went through this no IRA withdrawal zone here. What happens if we add $10,000 of IRA withdrawals, whether from a pension, whether from RMDs, whatever it might look like? We have an extra $10,000 of ordinary income taxed withdrawals. Well, now we see, again, before this 8.5% zone started here at 40,000, well, guess what? It's starting here a little bit less than 20,000. So that's what I meant by every dollar of IRA withdrawals essentially removes $2 worth of that standard deduction in a sense. Okay. Whoops. So you'll notice this, any IRA withdrawals that we add in here, okay, because we're essentially eliminating the standard deduction now because we're not in that 0% zone for long-term capital gains. We're being taxed at IRA rates, ordinary income rates, and we're moving Social Security benefits into being taxed as well, that we're removing a lot of that standard deduction. And so again, we see this 8.5% zone come sooner. We see a 10.2% zone, as we discussed before. That's, again, 85% of, a provisional income rising, being taxed at 12% there at 10.2. And then we once again see this 37.95% zone that, once again, everything moves over this way. It happens much sooner. Obviously, that's very important to know. let's say we raise that to an extra $10,000 of IRA withdrawals. Again, let's just say the pension was that much larger, RMDs were that much larger. Once again, we see that this standard deduction, that stretching of the standard deduction that we got before from capital gains, now is completely eliminated. We basically go right from the start being taxed at this 8.5% zone. Then we see the 10.2% zone come sooner as well. And then again, everything shifts over the more that we have in IRA withdrawals. And so again, let's just look at one more $10,000 incremental increase. We don't even see the 8.5% zone here. We only see the 10.2% zone, and then 37.95%, once again, moves over this way. And so we see that we have a lot of opportunity. If all we have is long-term capital gains that we're realizing in a given year, we have a ton of room to have some fantastically low marginal rates. But as we start to stack things on together and we have a base of IRA withdrawals, and then we're stacking on long-term capital gains, we see that, again, we might still be at pretty good marginal rates relative to taking more from our tax deferred account. Obviously, we would be at better rates, in that, decision period. But nonetheless, all of this tax trap moves forward in time, okay? And so understanding now which accounts to take from at any given time is extremely important. We can understand that, again, when we have different tax buckets with different marginal rates, we can see there's a completely different, these are not equal, if you will, okay? Or, in easier terms, these are not equal. The marginal rate when we're in a Social Security tax trap, if we take a dollar extra from our IRAs, that has a completely different tax implication than if we take a dollar from our taxable account and we take a dollar worth of long-term capital gains. Now, here's the thing. Retirement is a layered decision-making process. What you'll see is the more complexities that you dive into, the more complicated things get as we add in additional considerations. This does not mean that we should try to simplify things to make things easier. We have to dive into the complexities in order to make the best decisions for our retirement. This is why I make a case that, using a retirement planner that understands all of these different complications and layered decisions is obviously very important, but at the end of the day, that has to be your decision. But let's say the first layer then is, okay, we can see that if we took a dollar, at given rates or at given times, if we took a dollar from, let's say, our IRA, we're going to have let's say we're taxed at 12%. We're going to have a little bit more because of that Social Security Tax Torpedo that, let's say our marginal rate is 22.2% because we're essentially, realizing income in that 12% zone, but then we have that step up because of the Social Security Tax Torpedo. Said otherwise, again, as we just showed, we might be in more of a, 10.2% zone if we take from our taxable account, let's say. And so people will stop there. They'll say, well, I'd rather have 10.2% rather than paying 22.2%. But that's just the first layer decision. It's about what can we save this year? And obviously we want to be looking at what we can save this year, but we also have to be thinking about the future tax implications. So for instance, if we're right on the border of RMDs or we're in RMDs, let's say, we know that RMDs increase through time due to something called RMD creep. That's what we call it, RMD creep. That, as your accounts grow larger, as you age, you're set to take more in RMDs. And so we might be making a sacrifice where we, ensure that we have better tax savings this year, but then we screw up our situation for the next following years because now our RMDs grow larger and we don't have the choice. We have to take from our IRA withdrawals. So that's another layer deep. It's not only the tax this year, but what are the future tax implications? Should we actually be taking more from our IRA account despite having to pay more in taxes because that's better for our future tax liability as well? Okay, there's another layer there. But then there's also an additional layer there where, depending on how old you are, okay, these two accounts have completely different estate planning considerations. When you pass an IRA on to the next generation, they have 10 years to take from that IRA, which means they're taking fully taxable income, based on their tax situation, and they're having to take it all out within 10 years. Now, if you're passing on a small IRA, maybe that's not that big of a deal, but if you're passing on a fairly large IRA, that's a very big deal. They're going to lose a lot of tax dollars because of being forced to take large RMDs. Versus this taxable account, we know you pass on, at least right now with the rules, you get a step up in basis. So any unrealized gain that you have, your heirs essentially get a step up in basis. Their cost basis is now the market value at the time of inheriting that given account. And so a taxable account is oftentimes, if you have $1,000 or let's say $100,000 in a taxable account with unrealized gain versus $100,000 in an IRA account, typically it's much more tax beneficial to the next generation to pass on the taxable account versus the IRA account. So we have another layer of decision making that we have to make here. But again, understanding at the very least the tax implications this year and understanding which tax bucket you pull from and how that changes your situation is extremely important. The future tax implications, that's probably a 4-hour training as we talk through all the complications and complexities on that front. But let's kind of talk through someone who has $60,000 of Social Security income. They have a $20,000 RMD. That's going to be that base level that they already have to take. They don't have a choice over that. And then they have $5,000 of long-term capital gains. That's just what I would call a tax nuisance. It's tax drag from their account, dividends, mutual fund capital gain distributions. These are basically the base levels that they were forced to take. All of this is forced income so far. So they have at the very most $85,000 of income that they're taking. But what happens if they need $105,000? Okay, now all of a sudden, again, we have to look at breaking these. I've said in past presentations that's very important to know what your tax brackets look through time. Basically, having your tax brackets like this laid out so that at each level that you are at, we know, if we take additional dollars, what our marginal tax implication is. Okay. And what this looks like for this specific person is we have your long-term capital gains tax implication over here, and we have your, this would be your IRA, your ordinary income rate tax implications over here. And so we see if we start to take additional dollars of long-term capital gains, we're at an 8.5% taxability, marginal tax rate. If we take extra dollars from our IRAs, additional dollars on top of RMDs, we're at 18.5. So again, in this tax year, it looked like it would make the most sense to take from our taxable account. That's not surprising. Again, we have a more preferred tax rate from our taxable account. But again, it's thinking about this also in terms of this RMD, if we don't take out more than this RMD, likely is going to grow depending on how old they are. Okay, so they're going to be forced to take additional dollars each and every year, where right now we have the choice. We have the choice to take income in this 18.5% zone and prevent us from taking in this 22% zone. Next year, the following year, we may not have that choice because our RMD has grown. And so we have to be thinking about the tax implications. It might make sense for this person, even though it looks like this tax year, it makes more sense to take income over here. It might make sense to at least take additional IRA withdrawals in this 18.5% marginal rate zone in order to slightly decrease RMDs moving forward in the future. Again, their RMDs probably still will rise depending on growth, depending on how old they are and what that longevity increase is for that life expectancy factor for RMDs. But this is where the layered decision and complexities arise. And hopefully you can start to see how important it is to be thinking through these given complexities, thinking through these given layers. Okay, not only taxable situation this year, but moving forward into the future. And what conclusions can we kind of take from this training? Hopefully this kind of showed a bunch of different ways that your long-term capital gains fit into the Social Security Tax Torpedo. Translates to a whole different marginal rate, depending on, again, if you're taking IRA withdrawals, if you're taking long-term capital gain withdrawals, or if you're taking a combination, it completely transforms your given Social Security Tax Torpedo. So again, a lot of people find the Social Security Tax Torpedo confusing. I was certainly one of them. I think when I was first learning about this, I had to read examples 10 different times until I finally got it to click. And so maybe some of this is starting to click for you guys, but I'm now adding additional complexities on where, again, depending on which accounts you're pulling from, it completely changes that given tax torpedo graph. But we've talked about in previous training we did last year, around 3 reasons to perform Roth conversions in 2021, 2022, and beyond. Okay, avoiding tax hurdles like the Social Security Tax Torpedo is a big one. But we can also start to see, as we move through these, decrease future tax risk, make other assets more valuable. We can start to see how, and again, I'm not making the case that you should do this, it all depends on your situation, but if someone was able to completely eliminate tax deferred dollars in a very prudent way, basically Roth convert most, if not all of them, we see how you're in a fantastic position if you still have taxable account assets and Roth assets to realize long-term capital gains into some fantastic zones. Even if we have still just a little bit of tax deferred dollars, we still have that long-term capital gain zone. Again, going all the way back here, if we cap our IRA withdrawals into the $10,000 and $20,000 range, we can see that all of a sudden our taxable account is significantly more valuable than taking from other accounts because we're still realizing and having this stretch of the standard deduction. And at worst here in this 8.5% zone. So as you eliminate tax deferred dollars, you eliminate some of these complexities And you make other accounts like your taxable account that much more valuable if you're able to, again, do it prudently enough. And again, this is going to vary widely for everyone's situation, what prudent means, how much taxable deferred or tax deferred assets they should leave, how much taxable assets they should leave, and kind of how this whole, big complicated equation fits together. But again, hopefully you can start to take some of these conclusions and see kind of how complexities rise within this given training, seeing how that's the layered discussion. So hopefully this was informational. Hopefully it showed you a little bit of another look at the Social Security Tax Torpedo, looking at how long-term capital gains are realized in the Social Security Tax Torpedo. Always remember, you don't need more money, you need a better plan. If you're watching this on our Safeguard Wealth Management YouTube channel, please hit the like below, hit the subscribe button. We release videos on a weekly basis that'll help you find those videos and be notified of those future videos. If you're on the our Retirement Mastery Facebook group, let us know if you have any questions below. If I didn't see any questions during this presentation, I'll make sure I answer them afterwards if you're watching the replay afterwards. Thanks for watching.